Hey, what's up, guys? Welcome back to the channel. My name is Frank Mularcik, and this is episode 8 of my Dow Jones Industrial Average stock analysis series. And in this video, we're going to be doing a stock analysis on the 7th smallest company in the Dow by market cap, and that is Caterpillar, ticker symbol CAT. If you find value in my videos, make sure to like and subscribe so you don't miss out on future content. This is Frank Mularcik. And as you can see in the spreadsheet here, we've analyzed these first 5 companies, and the 6th company we analyzed was Goldman Sachs here in the last video. So we'll check that off, and definitely go check out that video if you did not see it yet. And the next one here obviously is Caterpillar with a market cap of around $109 billion as of right now, which is May 14th. So the first thing that we're going to look at for Caterpillar is their earnings report from the first quarter 2022, and these were reported just about 2 weeks ago on April 28th. So they had first quarter sales or revenues of 13.6 billion, which was up 14% from the prior year quarter. And then they had profit per share of $2.86 adjusted of $2.88, and that was only up a few percent, around 3% from the previous quarter. So I think, supply chain is definitely a bit of an issue for Caterpillar, and they said something down here. The CEO said, "I'm proud of our global team's performance as they achieved double-digit sales growth despite ongoing supply chain challenges." So even though they had a lot of sales growth, I think the supply chain may have, limited their earnings growth a little bit. I guess that's sort of just speculation on my part, but I think that could definitely be a factor. And operating profit margin was 13.7% compared with 15.3% last year, previous quarter. And they returned $1.4 billion to shareholders with about $600 million in dividends and $800 million in share buybacks in the first quarter, which is super exciting as well. So now we're also going to look at the 2021 annual report. This is just sort of a report that the CEO and chairman basically put together and put out to shareholders. And then we're also going to look at the official 10K report, which is what Caterpillar files to the SEC every year. So the first thing I wanted to talk about was service sales, which grew 17% in 2021 to $19 billion. And it says they're leveraging data and analytics from more than 1.2 million connected assets to proactively provide customers with insights and tools to manage their fleets and operations for increased productivity. And they're expecting this services sales to grow to $28 billion by 2026, which is pretty exciting. And I think this is, one of the biggest ways that Caterpillar can leverage, like big data and stuff like that in this, technologically savvy age, of course, to really bring in some more revenue there. Obviously, a lot of their products are, machines, and those can have lots of technology in them as well, but the sort of data analytics side of it, I can see a lot of potential there for, helping customers, predict when things are going to go wrong, and helping them when things do go wrong on just a better relationship in general, I guess, is what I can see there happening. And they also talk down here, these are sort of the annual highlights, which we'll go through. So sales and revenue. 2021 is still down from 2019 levels, but definitely a good rebound from 2020. Same thing pretty much with operating profit. And we can see the sales breakdown by region. So a little bit less than 50%, 40 to 45% of sales are in North America, and then the other areas are split up fairly evenly, I would say. And dividends steadily increasing, and we'll look some more information about the dividends in a little bit. And one of the other things that I wanted to go over was the autonomy. So they have about 500 autonomous trucks currently at 18 sites on 3 continents. So that's pretty exciting that they're, moving towards that, and seeing some customers that are interested in that as well, which obviously there's going to be some challenges along the way with that, but that's definitely the future or that a lot of people see, and especially with more industrial work, I guess, like this, where there's I guess more risk of people being injured and stuff like that. Autonomous vehicles in this case could be super helpful. And it says moved more than 4 billion tons of material with no injuries, which is definitely a good track record to start off with. They also talk about remanufacturing, which they are, working on, and I think that's a super good thing for them to be doing, because first of all, it's recycling essentially, but also that could help ease some supply chain issues per se, because if they already have like most of the machine there and they just need to refurbish it and maybe change some parts out, replace some parts, then that's definitely a lot less new materials that need to be used, and just less costs for them in that case, where they probably won't be able to sell that machine for near as much because it's technically not brand new. But I think that's a good strategy for them to take in general, I would say. And then I also wanted to talk about the individual kind of markets. So in construction, they saw strong demand and double-digit growth across all their regions in 2021, and lots of infrastructure spending for sure, at least in North America and probably other areas, which is definitely helping them out. And then in the resource kind of mining industry for them, they have double-digit growth again in revenues across all regions, and there's a strong demand that they're seeing, in kind of like these mining applications, and a lot of it is due to kind of, the age of vehicles. So the average fleet age is kind of driving demand. A lot of companies, I guess, are having a lot of older machines, and so those need updated or replaced. So that's definitely good to see. It's probably sort of a little bit of a cycle there, but it's good that right now they're getting that sales and business. And then I think that was it for this report. Moving on to the 10K here, just looking at the balance sheet. So current assets sitting around $43 billion here, which is up from 2020, which is pretty good to see. And the one thing I noticed that was pretty drastically different, about $2.5 to $3 billion more in inventories this year than last year. And I'm not exactly sure why that is particularly, or if that's a particular choice, but from my point of view or thinking, I would think that's a good thing given like supply chain issues. If they have more inventories on hand, then potential supply chain impacts and stuff like that might affect them less, as they already have more inventory, and so they have less need for new inventory and raw materials and stuff like that. So that's just kind of my thought process. Maybe that doesn't make sense, and looking at current liabilities, only around $30 billion, so definitely a super solid current ratio there, greater than 1, which is good to see. And as well, looking at debt, they have from here, we can look at long-term debt due within 1 year, so about $6.5 billion of long-term debt due within 1 year, and then the rest of the long-term debt listed down here is about $25.5 billion, and we add this $6.5 billion. So for me, what I'm seeing on the balance sheet, it shows about $32 billion of long-term debt. When I looked, on other websites that listed net debt, it didn't exactly align with that, but basically I used the other calculations or other net debt values when doing my DCF calculation. But I just wanted to point out here that it looks to me like they have less debt than those other websites were saying, because they have about $9 billion in cash on their balance sheet. So with $32 billion of debt, subtracting that $9 billion of cash would give us net debt of more like $23 billion from that calculation. But overall, I think the balance sheet is looking pretty strong. Total assets of around $82 billion, up a few billion from the year before, and total liabilities, up a few billion as well, but not that significant, I would say. And shareholders' equity is, where was it? It's right here. So up about $1 billion, which is definitely good to see shareholders' equity rising. So now looking at the dividends here, Caterpillar has a current forward yield of about 2.1%, 2.2%, which is definitely conservative when it comes to dividend companies, but we can see they have plenty of room to grow that dividend based on that payout ratio of 41%. So definitely expect some good growth, I think, and I would like to see that as well. And their current 5-year growth rate average is around 7.5%, which is pretty solid. And I think that's a nice number for a stable company like Caterpillar, a well-established company like Caterpillar that is worth, $100 billion. That's a pretty big company. So Ideally, I would like to see it a little bit higher, but it's better than some other industrials companies for sure, and so I will take that. It says here on Seeking Alpha dividend growth of only 1 year, and I think what Seeking Alpha does is when they calculate this dividend growth, they just look at dividend increases. So basically, 1 year of having a dividend increase every single year, or a dividend raise, that is, during that calendar year. But that's not really how the calculation works. It's based on, the total dividend paid in the calendar year. Is that value increasing? So when you look at it that way, then Caterpillar has been raising the dividend for 28 years. If we look at the dividend history here, you can see in 2019 they paid $1.03 in the third and fourth quarter, and then throughout all of 2020 they paid $1.03 each quarter. But the cumulative amount they paid in 2020 was $4.06, or $4.12. Sorry, which compared to the cumulative amount they paid in 2019 is greater, which is less than $4. Looks like that'd be about $3.78 maybe, if I did that correctly in a quick calculation. I think that might actually be right. But anyway, they paid more in 2020 than in 2019, so that's all that matters when it comes to that. So I don't know why Seeking Alpha is kind of annoying when it comes to that. They don't always have those values right, but usually when for my scripts, when I get the dividend growth value, I get that from marketbeat.com, which is usually very consistent in having accurate data. So moving on to sort of some valuation metrics. If we look at the earnings here, they were pretty, they actually had some problems back here in around the 2017 range, but they grew their earnings pretty quickly to around $10 per share in like 2018, 2019 range. Obviously, they had some problems due to COVID, but it's good to see that those earnings have jumped back up to, $10, $11, $12 per share. And definitely be looking at the next few quarters to see if they can sustain that and potentially grow those even more. It's kind of hard to look at this PE ratio chart because of this huge spike here. So I'm going to zoom it in and hopefully we can get a better perspective. And basically, if we look at it here, we can see in general their PE ratio has been in the 10, 15, 20 range. In 2021 it was up above 30, 35, 36. Right now they're around 17, which I think is fairly solid for Caterpillar. Not the absolute best, but if we compare it to the industrial sector as a whole, the industrial sector has an average of around 18.9, so Caterpillar is below that. And then within this farm and heavy construction machinery industry, Caterpillar is also below that average of 25. So both good signs there for the PE ratio. And the next thing we're going to look at is our discounted cash flow calculation. And this one is a little bit interesting. So basically, the calculation shows a fair value of $135, which is compared to the buy price of $122 and the current price of $204. And I guess there's a few things to keep in mind here. One of them is that Caterpillar was substantially affected by COVID compared to some other companies, I would say. And so, basically what we're doing is we're using past revenues and past income values to predict future free cash flows. And so when we look at past revenues, their revenues were definitely hurt some in 2020, but their income was hurt much more than their revenues. And so those margins were basically a lot lower in 2020. So if we kind of look at this is kind of how I calculate some of the things in the spreadsheet. So right here is basically their revenues over the past 4 years, and then their income over the past 4 years. And I'm basically calculating the margin here. And then we're predicting out revenues for the next 4 years. And then based on that margin rate, we're predicting out the net income. And then we look at, so basically, because of this outlier in 2020, I would say the average margin is a little bit lower. So in that case, these net income values would be a little bit higher. And then we're using that net income to predict free cash flow. So then those free cash flow numbers would be a bit higher as well. So, overall, I think Caterpillar is a good company it's like a good fit to do a discounted free cash flow calculation on. I don't know why I keep saying discounted free cash flow. It's just supposed to be a discounted cash flow calculation, but hopefully I'll get it right someday. But to get back to the point, they're a good company. They're a good candidate to do this kind of calculation on. And so, I have a fair bit of faith in this calculation, but it's important, I guess, to keep in mind that we're using the past few years of data to try to predict the future, and we're hoping that the future years, on average, don't have as poor performance as the past few years on average. So I would take this with a grain of salt. For me, I've sort of been buying Caterpillar in the 190 to 200 range just a little bit. I'll definitely be more excited, down in the 150s, 160s. That's where Caterpillar looks really good to me. And if we look at a chart going back 2 years here, this basically just shows, this is back to May of 2020 basically, so right after, a little bit after the bottom in March of 2020. So a pretty awesome rally all the way up to around 250 here. And then we've seen some kind of choppy action here. And right now, the thing that's interesting, I think, is these, up and down movements are kind of diverging. We can see these dashed lines here are kind of going further and further apart. So almost like increased volatility. It's a little bit harder to predict at this time. But if we zoom in here to the 1 year, I think for me, I think there's some decent support in this 190 to 200 range, which is kind of about where we're at. But just given, for me, I think the size of my position in my account and a variety of other factors, including, valuation and stuff like that, I'm not really that excited about Caterpillar at these levels. I have bought some over the past few months on little dips into the 180 range and 190 range because I think that's not terrible, and I just wanted to be that position to be a little bit larger in my portfolio. But overall, I'm not going to be buying much unless we see some bigger dips, I think. But it is a super solid company. I think they are growing revenues and earnings at pretty nice rates over the past 5-10 years, which I think is good to see. And I think the market for their products is not going anywhere at all. And the balance sheet is pretty strong. I would like to see a little bit reduction in that debt, but overall I don't think it's too big of a deal. So let me know what you guys think about Caterpillar stock down in the comments below. I would love to hear any opinions, and I just want to thank everyone for sticking around to the end of the video, and I'll see you in the next one.